and I mentioned some of these previously, and I'll talk a little bit more about it. The important point is that whatever debt you take off, you have to pay somehow with your retained earnings. In other words, if you take on debt to buy new equipment, you have to pay that debt off on a regular basis with profits from your operations. So anyhow, how do you actually pay for debt, and what's sort of the nature of it? Well, bank loans. The nature of a bank loan is you have to exhibit that you have underlying assets. You have to demonstrate to the bank that you have underlying assets which they can secure against your debt. In other words, they'll lend you money, but they want to know if you're unable to pay that money back, that you have some assets which they can sell and then use that to repay the debt. So they're obligated to do that, and that's part of their deal. The nature of the bank is that it's a regular payment. It can be, the amount of the payment can be irregular, but the timing of it certainly isn't. So every month you're obligated to come up with your debt, with your repayment schedule. Private placement bond issues. Corporates, it's a different sort of finance. Rather than getting a bank loan from a bank, you issue it's generally a service provided by a bank. But what they would do is they would place this to companies who are interested in investing in your company because it pays a regular. So pension funds buy lots of debts because they have lots of pensioners who rely on regular payments every month. So pension funds know that they need to deliver cash to their customers. And so as a result of that, are quite attracted to financial arrangements where they make an investment and they receive a regular payment that goes off into the future. Banks offer additional services. It's almost impossible in a cash flow dominated business like construction not to operate without an overdraft or some line of credit. Might be 100,000 or 200,000 up to millions. These are just short-term, usually high-interest arrangements with the bank. Just so when you write your payroll, when you write your payroll checks, they don't bounce. If your payroll checks bounce at the end of every pay period, then you'll have to call in the administrators. It's illegal to run an operation where you can't pay your employees. Bonds, I mentioned bonds. I should mention that there's quite a lot of sort of variation between the types of bonds. Bonds can be, you pay a fixed interest every month, a fixed amount every month, or they can be variable based on some underlying interest rate. Some are full repayment, so by the end of the term of the bond, all of the bond has been repaid. And some, like the one that the college in the coursework used, they simply have to pay the coupon off every month. And then at the end of the term of the bond, they have to repay the principal amount. So they have to pay a fairly small amount every month up until the full termination of the bond, and then they have to repay it in full. So there's different types of bonds. And there's a certain risk associated with bond repayments from the point of view of the project manager. You've got to make those payments. If you cannot make those regular payments, then you're in default, and that they can seize your assets. They can insist that you call in the administrators. The administrators will investigate where your underlying assets are, whether they can liquidate them and use them. And something called equity funding, and I'm going to talk a little bit about this because equity funding is associated with venture capital, and venture capital is the financial system that has been used to fuel the high-tech revolution. So venture capital fueled Silicon Valley, it fuels the biotech revolution, and it's simply a boutique type of banking that relies on shared ownership of a project. So this idea behind venture capital, I think, is really interesting and important. Now I think I've talked for a good 50 minutes. So what I'm going to do is just take a short break, and if you come back, I'll finish this lecture and then the next one as well.